What's up, gang? Familiar face. I got Chris Payne here with University Lending Group. And I say familiar face, he's been on the podcast a couple times in the past. He is someone that, what's your official title?
Pretty much just a partner in the First Lien HELOC is kind of what we call it.
Yeah, in all transparency, I am too. So he's a partner of mine in that same venture. I obviously handle the Replace University side. He handles the bank side. And one thing that we want to talk about today is, you got the rise of interest rates. Spike. I mean,
oh yeah,
I feel bad. We still got a lot of buddies and friends in the mortgage world, and I know what's bad for them is good for us, but you can't help but feel sorry for them because right now it's a bloodbath. And in the last 2 weeks, we've seen this before, but not this fast. I mean, in 2008, rates went through the roof, and it really decimated the mortgage industry. But this happened in 2 weeks, where that was like a year.
And I think in 14 and 15, we had a tick up as well.
Yeah.
So
rates. Mortgage rates are through the roof. Actually, we was talking to another buddy that was pricing out some investment property, rental property mortgages. And it was set to get 7%. The borrower was going to have to pay 7 points to get 7%. So obviously that's something that Fannie and Freddie just don't want. They don't want that paper right now. And where is the safe haven for people to get financing on rental properties? And that's a little bit about what Chris and I are going to talk about. But first, we're going to talk about interest rates. And we've said this time and time again. We'll say it again. Interest rate dictates payment. It does not dictate necessarily how much interest you're going to pay. With our strategy and our loan products, which is the home of the smart loan, is what Chris came up with University Lending Group. That attacks time and balance. And time and balance is far more important than interest rate. That's where you're going to feel the effects of how much interest you're paying. And one way to look at it is take a look at a loan estimate, right, on your conventional mortgage. You'll have your note rate on the loan estimate. That's the first page of the LE. But on the third page of the LE, you're going to have a different number, and it's called total interest percentage. Well, before I get into total interest percentage, let's talk about APR. So you'll have the note rate, then you'll have the APR. APR is telling you what your interest rate is as a reflection with the combined closing costs that are financed into that loan. So essentially, let's say you're borrowing a $300,000 loan. Well, you're actually only accessing, let's say, $290 because they may have had $10,000 of closing costs lumped into that loan. So really only $290 of it's being used. So now you recalculate for what the interest is, and that's how you get APR. But the most important number that you should be looking at in terms of a mortgage is on the third page of the loan estimate, and that's called total interest percentage. That number, especially today, 2 years ago, different story when rates were 2.65, you're probably looking at a tip of 55, 65%. Now that mortgage rates are north of 7%, that tip is probably going to be in the neighborhood of 85, 90%, would you say? So that's how much interest you're paying. So essentially what that document is telling you is that you're buying one home for you and one home for the bank. But our product, the First Lien Position Home Equity Line of Credit, it acts no different than a checking account, but it's also replacing the existing mortgage. This way your cash flow actually goes to work for you. See, a mortgage was created to segregate your income, and it's forcing you to separate yourself from your cash, right? So I think it was Grant Cardone that said cash is trash. And so what I mean by that is if you take that cash and put it in a checking and savings account, right now 0.25%, but then you've got inflation of 8.3%. Well, what's your return on investment there? If I sock cash into a checking account at 0.25%, but then I have inflation this year, again, we're talking September 27th to 2022 of 8.3%, what is my rate of return? Well, there isn't one. Actually, you have a negative 3,220% return. So you're actually losing the power of those dollars by 3,220% a year. So that's what a mortgage was really designed to do, is to separate you from your cash and get you to put your excess funds into a checking and savings account. However, with the Home of the Smart Loan, what it's acting as is it is your checking account. So not only is it a great vessel to store cash, when you're storing that cash in something that is actually suppressing the balance of that loan, it's also suppressing the amount of interest that you pay. So let's talk about some of the features that the Smart Loan has that, when I say it's just like a checking account, what are some of those features that make it look like a checking account?
Well, I mean, we have everything. We have the checks, we have the debit cards. It's daily interest, cash in, cash out. And so, just like you said, in our product, the most powerful thing is time of balance.
Mm-hmm.
I mean, it just is. I think I chimed in one other time, and it's all in how we've been conditioned to think. And right now, the media is driving the fear mongrel of rising interest rates. Mm-hmm. Well, let's talk about depleting balances.
Right.
We've got a huge portfolio of replace your mortgage clients,
mm-hmm.
and our balances, and we monitor this as a bank, our balances continue to fall far more aggressively than a traditional mortgage.
Right.
Without any question.
Hence the lower default rate.
100%. Default rate's at 0. And so that is the main.
Before you move forward, you just said something that I don't think a lot of people understand. Default rate's at 0. What does that mean?
That we've had absolutely, I think over the last 7 or 8 years, we've had 0 defaults on our.
So no foreclosures, no
mm-hmm.
freezing of the line of credit.
0.
And also no late payments.
Mm-hmm.
That's unheard of on a mortgage.
Correct.
Like right now, rates going up. We're heading into a recession. I think we're already in a recession.
Mm-hmm.
Call it a soft recession, whatever lingo you want to throw out there. Prior to this administration, a recession was 2 negative quarters of GDP.
Correct.
Well, we've hit that. Now we're going to hit 3 quarters of negative GDP, and somehow they're going to change the definition of what a man and a woman is and what a recession is.
You're exactly right.
So, we're in a recession, and things will get tight for folks. Unfortunately, utilities are up 17%. I was just reading an article where it was talking about the average American is now having to spend $4,000 more. Or I'm sorry, it's impacted them by $4,000 more this year than it has last year. And I think that number is way below what it really is because, let's take a look at 2 years ago. If you buy a $300,000 house, that same house, what does it cost today? Probably $390 for several reasons. Obviously, inflation being one of them, but part of inflation is increased lumber prices. So as lumber prices go up, you think the builders are just going to take that on the chin? No, they bake it into the price of the home. So you've got increased price of lumber. It's increasing the prices of real estate. You also have a huge demand with a lack of supply. So now that same house of $300,000 is priced in at $390. I mean, that's how quickly that happens. That you got a $300,000 house. 2 years later, it's a $390,000 purchase price. So there's $90,000 right there. But 2, it's financing it, right? So 2 years ago, pretty easy to get 275, 265 on a mortgage. Today, you're not even getting in the 6s. You're in the 7s. So that was a $1,300 payment. Now you're looking at a $2,500 payment because you're financing $390 versus $300 at a higher rate. That's $1,300 more per month. That obliterates this $4,000 figure that they're talking about of how much inflation has cost people. Not to mention, like I said, utilities are up 17%. You've got gas that's up, starting to come down. In my own personal life, I drive a dually. As you can see, when I say a dually, I drive an F-350 diesel truck. So I always make fun of Payne. Like Payne's always ready for 18 holes somewhere. It doesn't matter where he's at. Doesn't matter if it's winter. He's ready for 18 holes. And then he says, well, you're always ready to go hunting, even if it's in the summer. But I drive a diesel truck, and it costs an extra $600 a month to drive to and from the office. So, the middle class is getting squeezed, and you feel like there's not a solution out there. But there is a solution out there. What does the middle class, and especially the lower upper class, have is real estate. We own real estate. It's one of the greatest pathways to wealth or legacy planning is through real estate. So how do we offset or negate what's going on in the marketplace right now is we have to control what we can control, and we have to finance things in a smarter way, which is why you call it the home of the smart loan. So our average client saves $170,000 in interest compared to what they would be paying on a mortgage. So yeah, inflation's high, 8.3%, but it ain't 170 grand high. No. You take 170 grand over the course of 5 years, that's an average of $34,000 in savings a year. So there you go. There's how you solve that problem. But back to the home of the smart loan, and what people should be focusing on is combining your checking account and your real estate loan in one, right? And that's what the home of the smart loan does. And it has all those features. So you're liquid 24/7. So if you're somebody that's cash flow positive, do you want to share your famous line of who this is for?
Oh yeah, Carl Icahn, one of the greatest billion-dollar investors.
I was thinking yoga pants.
Yeah. Oh no, the yoga pants too is our products like yoga pants. Everybody can wear them, but only a few should. Obviously, I shouldn't wear yoga pants. That's why I have.
Nor
shorts
should
on.
I. Yeah.
Yeah.
What about those guys that ride on those little skinny bikes?
Solid. That's solid. That's tough. That is tough.
Yeah, I didn't ride a bike. I rode that Peloton in the gym.
Yeah.
It is tough. I can totally see, but you're just not going to get me in one of those outfits.
No,
I don't think they make them big enough.
Well, there's not many 6'4", 6'5" bike riders that's 300 pounds. So,
So anyways, it's for some people. It's honestly, it's not for a lot of people. It's actually not for most people, because what he's alluding to is you have to have already mastered your budget. You've got to be cash flow positive, which was the quote he was talking about with Carl Icahn. So the only way to influence this is you are bringing in more money than you spend, but it's how that cash flows that makes all the difference. In a mortgage, you couldn't put 100% of your income into a mortgage because it's going to be trapped. But with the smart loan, it's an open-end product. Money can move in and out freely 24/7. Talk about the recasting feature of it too, because that's something that a lot of people don't understand of how a HELOC is different than a mortgage and how a recast.
Well, in our portfolio, and we see clients all the time that are getting sales bonuses. They may have sold a piece of real estate over here, and they take and they dump that money back into their first lien HELOC on the primary residence. And then obviously, boom, that affects the amount of interest they pay. And then as they need it, it's available to them. So the cost to borrow is zero. Once they put it in there. And so, we're going through a time right now to where the media portrays, the fear tactic of higher interest rates. It's horrible. It's awful. I get all that. But at the same time, the media is ran by the Wall Street pretty much runs the media. And so what do they tell you to do on your investments, Michael? What do they tell you to do on your 401ks, on your mutual funds and things like that? Don't touch it. Just leave it alone.
Actually buy more. Buy the dip.
But we'll see people with $200,000 or $300,000 in their 401k, and they lose 20% of it, which is $40,000, $50,000, $60,000. They never say a word. It's just don't panic. Everything's going to be okay. But rates spike from 3.5 to 5.5, 6, and then the sky's falling. But that's only a $300 to $400 to $500, $600 a month effect, $7,000 a year, and then it's pandemonium. Whereas if you just stay the course, and you follow the strategy, it's going to be perfect. It's the quote I was talking about is where he says happiness is cash flow positivity, and that's what we're all about.
So cash flow positive being you make more money than you spend.
Correct.
And that's how you drive down this. The Home Loan Smart Loan is just a great vessel to store cash until you need it to deploy it for other opportunities. And that's something that's not being talked about right now. Is the recession brings about an abundance of opportunities. Every recession, there's been a massive transfer of wealth. That's when your millionaires become billionaires. Why? Because things are going on sale. People are, as Warren Buffett would say, be greedy when people are fearful and be fearful when people are greedy. Well, right now, people are fearful. So what is he doing? He's being greedy. So he's gobbling up things on a discount that people are offloading because they don't feel like they can afford them anymore. And that's one thing that this does is not only does it suppress your balance and decrease the amount of interest that you're paying, but it also allows you to maintain liquidity. So when these opportunities arise, you've got access to your capital when you needed it the most, for good times and bad.
Oh yeah, and we have some of the best features. We've set this up for your clientele, and we have some of the best features on the back end of any lending institution in the country.
One of the features that I really like, it actually helped us during the pandemic. When I say it helped us, probably 6 to 12 clients, so half a dozen to a dozen clients, that there was some that lost a spouse, a lot of people were furloughed or lost their job because of the pandemic, and they had their HELOC. They've been practicing on it for 2 or 3 years. So they had half of it already knocked out. Well, one of the features of this HELOC that some or most HELOCs don't have is if you don't make a payment, what happens?
It can feed itself.
It feeds itself. Actually, what the bank does is, well, you got plenty on your line, so we'll just add that to your balance. They don't report you late. You're not late, and
Mhm.
they obviously don't even foreclose on you, right? So in a mortgage world, what would that look like?
Terrible.
Yeah, you got 4 months of no payments, and it's time to start
A
packing.
lot of phone calls.
Yeah,
A lot
yeah,
of
it's
phone
time to
calls.
start packing. With this
Yeah.
one, you had clients that could weather the storm. I was talking to one client. The interest payment was $1,000, and they had 120,000 left on their line. Well, how many months can they go without making a payment? 10 years.
10 years. That's right.
They're not couch potatoes. They're not going to sit on the sideline for 10 years and weather the storm. They sat on the sideline for 6 to 7 months, got back on their feet, went back to practicing the strategy,
Mhm.
blip on the radar,
Mhm.
not a foreclosure. Think about if people were doing this, if most of Americans were doing this in 2008, would we have seen 2008?
No, not near as bad as it was.
Right. And in fact, what did we learn from our hedge fund buddies about 2008 when it came to first lien paper versus mortgage?
It was the most outperforming product in the market.
And now what are the hedge funds doing? Calling us, right?
Absolutely.
They want the paper because
Absolutely.
it performs. What they're wanting to do is buy first lien position HELOC paper to offset projected losses and defaults that they'll get on the mortgage side, because a HELOC can feed itself. So now we've talked about the benefits of a HELOC in the good times and bad. But that's one of the features of the Home of the Smart Loan that a lot of banks don't have is, yeah, you could do this on another HELOC where you have to move money out of the HELOC into a checking account and then from the checking account back into the HELOC. This one, you don't have to do anything.
Right. We made it pretty much seamless.
Right. Yeah, it's perfect for the strategy.
Yeah. Yeah.
Anything else you want to add?
No, not really. I mean, it's just again, the main thing is a mortgage. People tend to jump in and out, refinance every 4, 5, 6 years. Our customers stay with it. They love it. They get used to it, and it's self-sufficient, and there's really no worries to it.
Yeah, it's just stay the course.
Yeah.
There are other alternatives out there that maybe you get a little bit ahead here and there with promo rates or second lien this and all that. Look, we've been in business for 8 years, and we've seen multiple swings in interest rates. And yeah, we've seen actually in 2018, not this bad, obviously, but they spiked in 2018, then they plummeted in 2020. It'll be the same thing. It's spiked right now.
We still have the same clients from 18 as we do in 2022. They still have the same product under the same umbrella. And they love it.
Yeah,
they love it.
Interest rates will go back down. I don't know when. I don't hold the crystal ball to it. It's probably going to be September of 2023.
Maybe.
Actually, I have read a couple articles that talk about the second half of next year, interest rates coming back down. But, it remains to be seen. We'll find out a year from now if they're correct. But we might see a couple more Fed rate hikes. But again, this gives you access to your equity when you need it the most. I mean, think about the flip side of the equation. If you're in a mortgage, well, you've got unearned appreciation in your home that could help during these rainy days.
Oh, absolutely.
But nobody on that side of the coin wants to access it because they don't want to give up their 2.65 or 2.75% interest rate.
Yeah.
Where with this, you've been brainwashed to think that interest rate is the end all be all on the discount that you get on your home. And it's not. It's time and balance. That's what we've been trying to emphasize.
Correct.
So yeah, this one, stay the course, have your first lien position HELOC, ignore the noise that you see in the marketplace because there's nothing you can do about it.
Nope.
Other than two, just put more money in. And that's something else that we don't talk about. You've got access to capital. I was just on the phone with another potential client, and she's a business owner, but her husband's not, and said he wants to start a business. Well, you got $200,000 available to you. Is that enough seed capital to start a business? Yeah. All right. Well, if you start a business, are you starting a business to try to lose money? No. I mean, that happens, but no, you're starting a business to make more money. Well, if you start a business to make more money, what happens in this strategy? You actually pay it down faster. So instead of worrying about the interest rate, what you could do is pick up another side hustle, use this equity as seed capital to get a side hustle, go buy some cash flow appreciating assets, dump it back in your HELOC, and you actually just negated inflation. You also negated the rise of interest rates because cash flow is king. The more cash, the margin between what's coming in and going out, that is the end all be all. The bigger you create that margin, the faster you pay it off and the less interest you pay. So don't be fooled by these mortgage lenders thinking that a low interest rate is what's really going to save you money. It's going to be costing you hundreds of thousands of dollars.
Yeah, and give us a call because we can run the numbers. The calculator doesn't lie. We'll run the numbers, show you where you're going to be.
Are you going to give them your cell phone number?
Yeah. Yeah, I tell you what, you give us a call, you give Michael a call, shoot him an email.
No, you call them directly.
Yeah. Call Terry Frazier. Terry's phenomenal. He's one of our top guys.
I'll pull up his number right now.
He is our top guy. His number is 615-636-9677. That's Terry Frazier.
You've got that memorized. Good job.
615-636-9677. When you do as great a job as Terry does, you never forget his phone number.
Yeah, and we'll put it in the comment section below too, so that you guys have that phone number.
And let him do a comparison for you. It won't cost you a thing.
All right, guys, take care. God bless.
Thanks a lot.